Good morning, everyone, and thank you again for coming here, today to our monthly, AGEC market update. Today we are having John Robinson, who is going to talk about cotton market first. Then we will have Justin Benavidez talking about grain markets. And last, David Anderson is going to give us also, a short market update about livestock. If you have any questions, just remember, this is the time to go and ask all of them or any of us any questions that you have. You can just go and set up, you know, you can speak the question to talk about it or ask it or just write it on the chat, and I will, read the question afterwards. So, John, whenever you want to start, it's all yours.
All right. Well, good morning, everybody. Thanks for joining, and I'll get right to it. So, the drama continues in the cotton markets. You see this kind of roller coaster. This is a picture of the blue line there is the December 22 this season's harvest time prices, and the red line is next season's futures price. And you can see it's up and down, up and down. The first dramatic thing was back in May and June when the market had climbed for 2 years and it had almost tripled, and then it fell in a 50-cent decline. That happened in June. And then along about August, we got a really bullish, surprising supply and demand report from USDA, and everybody got scared that there wasn't going to be enough cotton. So the market shot up again. That was here. And it shot up and it peaked at 116, 117, something, I forget. And then we had another downturn. This is about a 48-cent decline. These kinds of things don't usually happen within the same year, within a same 5-month period, but here we go. So prices tanked again. And then about 2 weeks ago, we had this rather remarkable rally. The market was limit up for 3 or 4 days in a row, and we're kind of consolidating at the top of that last rally. This part happened, I think, because of coming out of the pandemic and worries about tight supplies. And then we were worried about a recession, so that caused that, I think. And then they were worried about a short crop. I think that caused that. And then they were worried about a recession again. I think that's what caused that. What caused this little bit at the end here was basically speculative buying. Look at these guys in green. These are people that make a bet that the market's going up or that the market's going down. That's what they do for their business model. I call them hedge fund speculators. And you can see right over here in about September, October, this downward poking green spike. What that means was that there were more of them actually making a bet that the market was going to go down. I guess they were thinking there's a recession, prices, demand for cotton is going to shrink, and we're going to jump on the bandwagon and sell it down. That's what they did back here 2 years ago. And, anytime it's pointing down like that, that's an outright short position. That means that investment people are betting that the cotton market's going to go down. Well, they got scared by something. Here they had all these short positions, which means they make money if the market really goes down, and they'll lose money if the market goes up. Well, along about here, about 2 weeks ago, there was an announcement in the financial press that China was going to be relaxing their rather stringent COVID-19 policies. If you hadn't been keeping up with that, China has had the strictest policies. They shut down the city of Shanghai for a month. There's 20 million people in Shanghai that couldn't even leave their flipping apartments or buy groceries or do anything. China was just doing crazy things, closing factories. People couldn't go to work. People couldn't travel. People couldn't do anything. And that's been going on for a year. Well, China made this big announcement right here that they were going to start relaxing that. And everybody instantly thought, there's going to be economic recovery because China's economy is going to recover. And the stock market went up, and the oil went up, and copper went up, and cotton went up. And the way it went up was that these guys who had a short position, they bought those positions back. They bought their way out. And that's what caused that last little, like a 15, 16 cent rally in the market. And it was caused by these guys bailing out of their short positions. They got scared, and they lost money on that bet, and they bought their way out of it. So anyway, that's all well and good. Now the question is, where do we go from here? This strikes me as kind of a temporary thing. So let's look at other issues in the market that may make it tighter and support prices, or may throw cold water on the whole deal. And the big question seems to involve this question of what's the estimated production. So right now USDA is estimating 14 million bales for the US crop. They actually came up in their November estimate over what they were projecting in October. That number's gone up and down from month to month. But usually by this time of the year, if USDA says that there's going to be 14 million bales, then they'll tinker with it. But their time is running out on big changes, big market moving changes. Ordinarily by this time of the year, what they project is starting to be in the ballpark. Okay, they're zeroing in on what the real number actually is. Now, if y'all talk to your farmers, farmers are always of the opinion that USDA's got it wrong, that there's a much smaller crop out there, and that prices ought to be higher. If you go on Twitter and follow cotton farmers from Texas on Twitter, that's what they're saying. Oh, y'all just don't know how bad it is out here, man. I mean, I drive around, there's no cotton anywhere, blah, blah. You hear that. I hear that every year, okay? Maybe I'm a little cynical, but I hear that every year. So when I hear it this year, I think, sorry guys, it's November, the crop is what it is. Or, like I say, they'll tinker with it some, but I generally disbelieve huge claims that things are going to change or things should change, except for one thing. And that is this is not a normal year for one thing in particular, and that is crop insurance adjusters are out there doing what they always do, going out to farmers' fields and saying, yeah, there's not enough here to harvest, and there'll be an insurance claim. That happens late in the year. There's claims early in the year about the crops that didn't emerge. And then there's claims later that are adjusted late in the year around harvest time, when the adjuster comes out and says, no, it's not worth harvesting. And so a lot of stuff gets zeroed out around harvest or right before harvest. This year, by all accounts, that whole process is backlogged. That is, there are crop insurance adjusters that are just way behind. I don't know why. Maybe there was more work for them. Maybe there's a shortage of them. Maybe half of them have COVID. I don't know why this process is delayed, but by all accounts, it's delayed. And that could mean that USDA, who's sitting around waiting on data on all these claims, this may be an abnormally late year for that, which means that they might be they might be cutting off another 500,000 bales in the next month's report, or maybe even in the January report. So this has got me watching, because this is different. So again, I don't know the answer. We'll have to wait and see. But if that gets tighter, then the bottom line, which is pretty tight already, 3 million bales of ending stocks, that's pretty tight. That's tighter than the previous couple of years. That should support prices and keep them from falling really too much from where they are. And maybe there'll be a little bit more in the route, a little bit more upside potential. If again they whack 500,000 bales off of that, it'll tighten it up some more. It'll probably won't rally to the extent that farmers want it to, because remember, these farmers, they lost the opportunity to sell cotton up here. Most of them didn't take any action. So now, 48 cents later, well, it's recovered to here. They want to see it go back to where it was. They remember these prices from only a few months ago. I don't think it's going to go back over here. I don't think it's going back over $1. Sorry. I think that opportunity's gone. If USDA cuts 500,000 bales out of out of production, maybe we'll rally back up into the 90s, maybe, who knows? Nobody ultimately knows. But I think that opportunity is just gone. So people will be sad about it, but that's the way it is. Okay, so looking ahead to next year, we've got two things going on. One is economics and one's the weather. So here's the drought monitor. We have had some rains. It hasn't been the driest winter in the world, but the soil's still dry, and the forecast is for drier than normal. The National Weather Service Climate Prediction Center says they're expecting the La Nina condition to go through February, and then it'll break down in the spring. But all that means is we'll have a drier than normal winter and then a normal spring. So anyhow, I'm expecting dryness, and I'm expecting fewer cotton acres planted. I said economics was the other reason. This is the ratio of next year's corn futures to next year's cotton futures. We did this calculation last Friday. Corn is a really, really high price. Cotton is not high enough to attract acres. So when you divide that by that, you get this ratio here. And historically, if corn prices are that good relative to cotton prices, man, we're not going to plant that many. This is 9 million acres. And we're going to plant a historically low level of cotton acres, I think, if these prices kind of stay the way they are. So the combination of a low planted acreage and dry planting conditions kind of suggests to me that we may have a really, really tight supply next year, and that will affect the market. The market's not anticipating all that now. It could be raising prices now, but it's not. So maybe it'll be next April, May, or June. But at some point, the market's going to realize, gee, we don't have many planted acres, and gee, it's not the best growing conditions in the world, and there may be a rally in the season next year sometime. So now there's still this question of, are we in a recession or not? Will we be in a recession or not? And there's evidence to kind of suggest both sides of this story. So I'm not sure how to size it up, but it's still a question. The demand side is a question. The supply side is going to be very tight. So it could be a very, very tight outcome, or it could be sort of moderated by shrinking demand, and we'll have to see. So pay attention, and your growers should pay attention to all the market reports and forecasts that are coming. You can kind of predict there'll be a lot of outlook. I'll be traveling around giving outlook at the Beltwide meeting in New Orleans in mid-January. There'll be a whole bunch of outlook that makes the press, and the Cotton Council is going to release some numbers in February that'll catch a lot of attention. So will USDA, and USDA will put out their planted acreage report at the end of March. And all these things have the potential to be very influential. So we ought to be anticipating them. That's all I've got. So I'll end my slideshow and turn it over.
Excellent. Thank you, John. You're still sharing, by the way.
Oh, stop sharing. There we go.
Hey, anybody has a question for John? Well, if you think about one later,
I'll be here.
John is going to be around, so we can ask him later about it. Justin, do you want me to present your slides?
Yeah, go ahead and try, since the last time it didn't work too well. Can you hear me okay?
I can hear you perfectly well.
Great. Yeah, if you wouldn't mind running them, since it seemed to have crashed my computer earlier.
Can you see them well?
I do.
Okay. Remember to say next if you need it, or go back. Okay.
Very good. Well, thank y'all for having me. I'm new to this check-in with the agents. For those of you who I might not have met before, my name is Justin Benavidez. I'm the district economist on Poncho's counterpart up in Amarillo. So happy to be here with y'all this morning. We'll talk briefly about the coarse grain markets, and then about the wheat market and where they're both heading in the foreseeable future. Here, looking at the cash prices for corn, sorghum, and wheat, kind of beginning our picture. If we look at it on a macro scale for the last 2 years, things began to trend upward there in 2020 in terms of price on some supply shortfalls in the United States and a few other countries. We had the derecho here in the United States in the Midwest, which really impacted a lot of the Midwestern corn acres. A lot of those kind of Dakota acres were lost into some severe rainfall. So that induced some shortfalls in supply. At the same time, Brazil was facing a drought, so we were in some of the opposing kind of weather patterns that we're in right now. And at the same time, demand was on the rise from China and Chinese buyers. Uh, ostensibly because of our trade agreement with them and the restrictions or the enforcement of trying to comply with their trade agreement with the Trump administration at the time. But the reality was, producers in China were buying feed grain to replenish their hog supply, as that African swine fever was a big factor in eliminating their hog herd, and they tried to regrow that protein supply. So that really began to drive up prices as we moved through the next 2 years. But then, we get to the Russian invasion of Ukraine, and you can see that blue line where grain prices really spiked immediately overnight. If we're looking and thinking about that being February 24th of this spring, we saw corn, sorghum, and wheat prices all skyrocket because both countries are major producers of grains, and Ukraine a major exporter of grains. And so as that tightening of supply on the world stage, or expectations of tightening supply on the world stage, really began to enter the market, we lost a lot of we lost a lot of the supply that we were forecast to have, whether or not it was actually going to make it out of those countries and onto the world market, which led to an increase in prices. You can see some really significant movements in price through the rest of the summer, based some more on information out of Russia and Ukraine. What we see here at the peak, right at $12.62 per bushel for wheat, and some peaks for corn and sorghum. Those were followed shortly thereafter by the agreement between the Russian and Ukrainian people on establishing a safe corridor for grain passage through the Bosphorus Strait and out onto the world stage. There were some questions about whether or not that was going to hold later on, almost about a month ago at this point. But then shortly after Russia pulled out of their agreement, grain ships still completed many of their passages through the Bosphorus safely, though Russia is kind of tepid in whether or not it's going to maintain that agreement. So I think that's creating a lot of the uncertainty that we're seeing in the market right now. But most of this kind of range-bound movement that we're seeing, I think, is going to remain until we really get solid harvest numbers in, with any sort of breakaways out of the range-bound patterns being a function of some unforeseen event, like another change in the Russia-Ukraine relationship. But if we move on to the next slide, what we're going to see is that grain use per capita really is a function of growing income around the world, and it's not just because of the demand for grains directly for human consumption. It's also a function of feeding more protein that will then be used for human consumption. And so as global income rises on a per capita basis, people demand more protein, and therefore we need more grains for more protein. And when we look at the short crops here throughout the last few years, the last decade really, what we can see is that consumption of grain, use obviously did go down in short crop years. And some of that isn't necessarily because we didn't have enough grain, but because of competition for the grain that we did have, really pushing prices up. And so in certain cases, people not being able to consume or afford as much. So slowing economic growth, which we are expecting in the near future, can be a drag on how fast we see use rebound. Again, if we think about income per capita being a driver of grain consumption and the potential for a recession in the near future, we could think about the potential for a decrease in consumption and a decrease in demand, which would begin to pressure prices downward. So if we think about moving on to that next slide, where we are starting this year in terms of grain stocks, this is the days of use on hand at the end of a marketing year. So that's how much grain we have in terms of days available based on demand. And if we look in this kind of tan bar, what we have is world days of use on hand. Yellow is world without China. So China really doesn't export a lot of its grain supply. And so we net that out of the overall supply picture. And then we have US days of use on hand here in blue. And you can see that we remained relatively flat if we net China out, and even if we were to leave China in, days of use on hand has really stayed pretty flat from 2020 through 2022. There's been some small movement in terms of days of use, but still within that range of 30 to 33 days of use on hand when we think about how much grain is available. So relatively tight stocks, that's going to lead us to some support for prices. But if we're in a tight stock situation where prices have been high, what that begins to show us is that we need more supply, and we can expect some potential expansion in acres as we move forward. And so if you look at the next slide with the information from the November 2022 WASDE, we do see an indication of the potential for more acres. So we think back to the previous slide where we had fewer days of use on hand available. We weren't necessarily as low as we could possibly go. Obviously, we could theoretically go to zero, but we've been in a relatively tight and flat level of days of use on hand, so relatively stable stocks. But all of that is showing us that there's room for expansion in terms of there's some more profitability in the corn market, some potential profitability in the corn market. Prices are high, and so what we can expect is an increase in acres. If we looked at the updated WASDE, the forecast is for additional acres and for a higher yield. So if we'll look at a yield slide here in a few minutes, but if we think about yield this year is going to be below the trend line for a lot of different reasons. John already showed that drought slide, which is going to have a significant impact on corn country. I think the last time I checked, something like 60 to 65% of the continental US was in a D0 drought. So pretty significant numbers there. All of that pointing to the potential for strong prices, which is going to pull more acres into corn, which then we would assume is going to increase stocks in the upcoming year. And when we see that days of use on hand get to 42, that's really kind of where we begin to see a break in price from these upper single digit values per bushel back down into that below $5 per bushel value. That's where it seems to hinge on. And that's a principle that has been, Dr. Welch talks about it a lot, that 40 days of use being on hand kind of being the breaking point of if we have less than 40 days of use on hand, we really don't have enough corn in the supply line to get it everywhere that it needs to be on schedule. And so that is a kind of a breaking point where we can see some real price changes. So if we look at the next slide, what we're going to see, the big acreage fight in the United States is always between corn and soybean acres. And so we look at the ratio of those two things together, and then we look at the price of those, it's the difference in those acres and then the ratio of the prices. We can see a relationship that indicates about where we expect production to be. So we've got corn acres minus soybean acres there on the left-hand side. And then we have the base price ratio there on the bottom. And what that begins to show us is an expectation of the relationship between the two. So how acres begin to stack up based on prices is what this chart is essentially showing us. And we can see that what it would suggest is that we're going to have more corn acres than soybean acres going into the next year. So again, an expansion beyond where 2022 has been. So we have a very close relationship between corn and soybean planted acres. We can see that we would expect that the next year's trend would suggest about 10, there would be a difference of about 10 million acres between corn and beans, as opposed to pretty close to even here in 2022. And so again, acres up for corn, we would assume that means higher supply. The only thing that could pull supply down would be yield. But as we'll see on this next slide, Pancho, yield is forecast trend-wise to be up in the upcoming year. So what we see here is 2022 expected yield, which is below the trend line. Again, a lot of that is because of drought conditions. But in the next year, if trend line yields continue to go up as we expect them to, we would see 180 bushel per acre yield. And so with acres up and yield up, the signal for the next production year is for lower prices And that can already begin to send some signals into the current year to pull some of our prices down in the upcoming marketing year. But in general, some moderated expectations for prices, and if anything, trending downward for corn. If we go to the next slide, what we'll see is what we'll have is right now we're at that point, both 2022 and 2021, we've had acres that were less, or excuse me, days of use on hand less than 40 days. And as I said, we're in that area where prices are higher. The example we like to go back and look at is during the biofuels era, that 2010, 11, 12, and 13. So record high prices. We're in that zone again right now, but if production moves up as we expect it to, with acres and yield being up compared to this year, we would see that we can expect to be back above this 40 days of use on hand, where we get back into those prices that are $5 a bushel or less, as you can see according to this chart, and even really congregating more around $4 a bushel rather than the $5 zone. So moderated expectations for price into the next year or two. If we move on and think about wheat very briefly, we've got another indication of days of use on hand, again with the world less China, and then the United States here in blue. What this shows us again is that we've been trending down in the United States in terms of days of use on hand for wheat. What that means is that stocks are getting tighter. The world less China, if we look right here in 2022, 2023, is the tightest that it's been since the early 2010s. So very tight wheat stocks compared to about the last decade. That's going to be an indication of higher prices, and we can see that's been borne out this year with some record-breaking prices for wheat in the marketing year that we're in right now. And so if we look onto the next slide, what we'll see is that those forecasts for higher prices are going to pull more wheat acres into production. And so USDA has called for more wheat acres, and then along with the same conditions that are leading to higher corn yield, we expect to see higher wheat yield move out of the La Nina conditions and into neutral. And in some cases, there are forecasts for El Nino conditions toward the end of the year. So higher yields and higher acreage would suggest that in the upcoming marketing years, not the one we're in right now, but the following marketing year, we can see an indication of lower prices going forward, at least down from what has been a record-breaking price level for wheat this year. So if we look on the next slide, again, as I've already kind of suggested, we're moving, and John showed us the current conditions. What we'll see moving from here forward, moving out of those La Nina conditions, which is down here towards the bottom side of this graphic, into neutral conditions, with neutral conditions suggesting at least average rainfall for the Southern Plains. And as we get closer and closer to El Nino, expectations of rainfall that is above average, or another way to think about it is above average chances for normal rainfall, right? So all of that to say, as we move further into the production year, it looks as though there's some potential for good, solid moisture to come in, and hopefully that suggests a good yield for the Southern Plains. That is, if the wheat can make it through the winter. I think at least in the high plains, what we've seen for the last 2 years is the wheat has really struggled through the fall and the winter, but getting one good rain there in the January, February period, or a good snow has really brought that wheat crop back. And so my hopes are not completely dashed for the wheat crop, at least on the high plains yet. And I don't know really the agronomics for the rest of the state, but if we can just keep the wheat alive through the January, February period and get back into that neutral setting, I think there are some potential conditions for a strong wheat crop. You're good, Pancho. We can go to that next slide. The principles for wheat, average days of use on hand, don't hold as strongly in wheat as they do in corn, but there are some, breaking points here that are a little bit more fungible between. We can look at 2022, 2021, higher prices here to the left-hand side of the green line, lower prices to the right-hand side, with 124 days being roughly a breaking point for those two. All that to say, if we bring more wheat acres into production, more yield online from better rainfall, we can certainly expect probably some pressure downward on prices And it's one of those things where corn stocks were low, and that kind of means there's not much anywhere to go for corn production but up. We're in the same sense for wheat prices, where wheat prices have been significantly high. There's really not much for them to do but go down in the upcoming marketing year. So strong through the remainder of this production year and this marketing year. When we get into the next marketing year, the forecast is certainly for lower prices, trending back down towards that 6.5 or maybe even above 4, but lower prices. All of this to say, with lower prices in the near future, there's some potential for your producers to be facing some crunches in their margins and profitability. This is fertilizer, natural gas, and corn prices. We can see that, fertilizer prices are tightly tied to natural gas and corn prices. We have seen a kind of a collapse there in the natural gas price over the last couple of weeks. But in general, we can expect that fertilizer prices will stay high longer. There's some more stickiness in that price series than there is in our commodities like natural gas and corn. And so as we see inputs stay high with pressure on output prices or our crop prices, that's going to begin to pressure our net incomes for our producers. We look on the next slide. When we've seen recessions in the United States, we have typically seen in the subsequent year a decrease and in some cases a collapse in net farm income. Didn't happen during COVID, but there was a lot of government money flowing into the farm economy to keep things stable at that point. But with and some price activity that was also very favorable in terms of the shortfalls we saw earlier. But we see prices coming down, input prices staying up, the possibility of a recession in the next year. We can certainly see some conditions that are possibly leading to some profitability crunches in the next year or two, even if prices stay higher than their historic averages, but come down a little bit from where they are. Those input prices remain high, which we certainly expect them to. We could see some net losses, and that becomes kind of a complicating situation because reference prices and some of our safety net programs aren't going to indemnify producers, even though they're facing some profitability problems. Last slide is another indication of the discrepancies in total gross farm income plus government payments and then cash payments. We expect to see that total gross farm income and government payments come down at a faster rate than cash expenses, though cash expenses might lower just a little bit. And that comparison between the two, with income falling faster than expenses, we can see inducing again some losses in the farm sector. So a couple of takeaways very briefly. Prices sustained through the remainder of this marketing year for both our coarse grains and our wheat market, but with the potential for some losses in the upcoming year. Pancho, that'll be on the next slide. I don't know if you've clicked forward yet or not, but high prices and high input costs. Our margins are already tight, so even where we've got profitability, there's the potential that some producers are facing losses because of high input costs. All the profitability that's out there and the high prices that we do see is bringing in more acres. We expect some of those additional acres in the upcoming production year to lower prices, and as prices go down but input prices stay high, we could expect to see the potential for some losses in the farm sector. So that's kind of the brief takeaway. I'm happy to stay on for any questions. I'll stick around for after David's talk as well.
Thank you, Justin. Great presentation. Let me stop sharing. If you all have any question for Justin, if not, David, did you get yours? There.
Can you see
That's
that,
perfect.
Pancho?
I can see that. Yes.
Fantastic. Oops. All right. Well, thanks, guys. Good to be with you guys today. Talk a few slides, a little bit of livestock stuff coming. I want to start with calf prices. And I'm going to use 550-pound number one steers, kind of Southern Plains. And I think a couple of things to highlight here is we've likely seen our bottom for the fall run of calves, and really these prices are reflecting sort of a North Texas, Oklahoma sort of market where I have kind of the best long-term data, but we tend to see prices decline into October and then rebound. We've got a rebound going on. I think we've got a couple of factors driving this. One is a little bit lower corn prices in the last couple of weeks. Those have backed off. We've got some positive returns to feeding cattle lately, and led by some higher fed cattle prices, up to $1.50 and higher in the northern plains and southern plains as well. So some profits on the feeding side, I think, are helping us out here, and some lower feed costs as well. I think one of the things that's dragging us down that we'd have even better prices is I think we have to consider, and same with lighter weight calves that would be headed to wheat pasture. I think if we looked at lighter weight ones, I think we'd be seeing some effects of a lack of demand for stocker cattle for wheat pasture, just because of the really lack of development and the expectations of not a lot of grazing. So any of these weight classes we look at were above a year ago, but I think that what we're seeing for wheat pastures dragging the lighter weight ones down. So a little bit lower corn prices over the last couple of weeks are helping us a little bit. So, but I'd probably suggest we've hit the bottom and are rebounding back up, and seasonally, normally we would see higher prices, and we would see prices increase from here on out for these 500 to 600 pound animals into, really into March. I think we're probably headed that direction. And I think we also ought to remember too that, we had fewer cows this year, so fewer calves. So we got a little tighter supplies of calves anyway out there. And so that's kind of helping us as well, I think. And we ought to expect that to continue to help us. I got a couple of cattle slaughter charts that I want to kind of make a point about. If we look at total cattle slaughter this year, and this is weekly data, heck, we go back here a couple of months, every week we're above the week before of the same week the year before. This is going back to an older kind of conversation since the pandemic about packing capacity and do we have enough capacity. And one of the things I would point out is that, heck, if we looked at marketings and cattle slaughter, marketings from feedlots, we continue to be above a year ago. That daily average marketing rate relating to the cattle on feed report and slaughter are running above a year ago. So we're moving a lot of cattle through. In fact, we're headed for record beef production this year. So this idea, do we have enough capacity? Have our capacity constraints eased enough to allow us to move all these cattle that we have, including more cattle on feed? And I'm going to argue that that's true, that this a heck of a lot of our labor concerns about labor supplies, these capacity constraints we have, I think we could argue a heck of a lot of those have already been worked through and are not as big a concern as they have been. So I want to start with that and show you one more. If we look at the number of cattle that go to packing plants on Saturdays for, I've sort of used this Saturday data. Gosh, I've been using it for 25 years. Really to think about, use this in sort of the context about our capacity constraints and do we have any available supplies relative to our ability to move them out. And what I would show is that last couple of month period are consistently our Saturday slaughter levels are well below a year ago, even though we're processing more animals. And so I think that what that kind of suggests to us in the big picture is that a lot of our worries about capacity or capacity constraints, a heck of a lot of those are gone. And so that's going to be less and less of a problem going forward. I think that also our ability to process those animals is contributing to some of these higher fed cattle prices as well over the last couple of months as well. So I thought this was kind of an interesting point to show this the declining number of Saturdays cattle slaughter compared to total during the week. And really, if we think about that as in terms of kind of capacity, I think that's kind of an interesting point to kind of think about in the broader market. I do want to show this thing on beef cow slaughter. I think everybody would know, I've used this chart a lot. Every week this year, we've moved more beef cows than we did the year before. Drought and high costs have forced us to cull into our herds. Normally in the fall, October into early November, we see our peak culling. Again, culling has increased. We hit almost 85,000 head 2 weeks ago. And I should point out too, there's a 2-week lag in this data. So as we think about this, the week before or last week, we were almost 85,000 head as well. So heck, if we look at that, we continue to move a lot of cows. I must admit, I had sort of hoped that maybe we pulled some cows ahead. Maybe that would kind of pull us down on our beef cow movements this fall. Yet beef cow movements are seasonally probably pretty close to as large as they should be, given what we did earlier in the summer. And so, really, we've got some weeks left. I'll be pretty interested in watching how many cows continue to go to market, and do we see that begin to moderate a little bit? So far, we haven't. What's that mean for cow numbers next year? A bunch fewer. I've continued to think that we're going to be at least 3% lower on beef cows year over year nationally. That's a pretty big year over year decline. Yet the number of heifers we're holding back, number of heifers we've sent to feedlots, and this large beef cow slaughter would suggest that's probably in the ballpark. So again, nothing's changed here to suggest we're slowing down cow slaughter much at all. I made a comment about returns to cattle feeders. This is a calculation that I've messed with for a long time, really just calculating, feeding a 750-pound steer, feeding them to a finished weight, not accounting for any kind of hedging or futures or anything like that, but really costing out buying feed each month, using no price risk management or futures or anything there, but just to get a kind of a basic look about returns to cattle feeding. And you can see the last 2 months, October and September, really returned us to some green ink. So some profitable conditions, particularly as fed cattle prices have increased. And again, those purchase prices when they were bought are relatively lower. And so that sort of moved these back into the black. And so really a couple of months of positive returns are likely kind of supporting some of our calf prices as well, and certainly feeder cattle prices as well. So heck, I think this is kind of an interesting thing to think about. Are our customers, if we're thinking about being cow-calf or stocker producers, are our customers, which are the feedlots, are they making a little money? In the last couple of months, they are. And I think that's a pretty positive outcome. We take a look at the number of cattle on feed. I included this chart simply because on Friday, USDA's next cattle on feed report comes out, and I do pre-report estimates, as many of you know. We fell below a year ago in October on the total number of cattle on feed. I've got placements at 100% of a year ago in October. I'm probably on the high side of the market analysts. The kind of some of the models I use, I tend to run a little hot on placements, and I chose this month not to pull back on my placements. So I have placements at 100% or equal to a year ago, which gives me cattle on feed at about 99% of a year ago, so down almost a full percent. So when that report comes back, what we ought to see is marketings were bigger than a year ago. Placements are going to be likely smaller than a year ago, keeping cattle on feed numbers below a year ago, which really gets us continued another month into fewer cattle on feed, tighter supplies for next year, and generally supportive of prices. And so I threw this out because this is pretty timely, given that the report comes out Friday. Maybe this will help you when you see kind of those numbers come across, sort of a view of what's going on. One thing's driving placements higher for me is simply the conditions of wheat pasture, and how many of those animals that could have gone to wheat don't, because they got to go to feedlots. So continued drought conditions, but again, tighter supplies of animals available anyway. So we've got this balance going on of how many calves already went to feedlots when they might have gone somewhere else is likely pulling down those numbers. But profits probably help some placements on the other side as well. And that chart on profits kind of indicates that. In closing, I got one last slide I wanted to show. Last week, the consumer price index came out. So that's the most commonly cited, broadest measure of inflation for the last at least a year. We've all been pretty cranked up about looking at the CPI results and that measure of inflation. I want to take a look at beef prices. Beef prices go into that consumer price index. And beef prices are an area where prices are falling, and they're falling below a year ago. In fact, well below a year ago. These are the lowest retail beef prices since May of last year. It's not a level that we'd sure call low. It's still pretty expensive, but we've certainly seen some declining prices as the wholesale beef market or the cutouts declined as well. We start to see some price declines here. We typically might say we see price declines this time of the year anyway, but we certainly got some lower prices. If we looked at wholesale, we've got wholesale box beef cutout prices below a year ago as well, and they have been for most of this year. We're seeing a little bit of adjustment in retail prices reflecting that. And so, I thought that was worth pointing out. There's an item here that is moving in the right direction for us consumers. Oftentimes we'll talk about competing meat prices, pork and chicken. I was going through some numbers this morning for something I was working on and writing, and pork prices have continued to go up. We actually have beef prices that are declining relative to pork and chicken. And so in relative sense, beef's gotten a little bit cheaper relative to our competition. And so I think that's something we haven't seen a lot of in recent years. And there's certainly times we worry some about competing meats from a demand standpoint. But in terms of for a little help to consumers, this is moving in the right direction. I don't think I would argue that this is indicative of poor demand or declining demand. I do think we have consumers switching around what they buy, but given that we're producing record amounts of beef right now, and wholesale prices continue to be below a year ago, I think we ought to see some translation of that to lower retail beef prices, and that's showing up in the data. So with that, Pancho, that's my last slide. I'll see if I can give up control of this thing and have it here for any kind of questions.
Excellent, David. Thank you very much for your presentation. Let me stop recording.
I think I stopped sharing. Is that true?